And we start. So I want to call the class to order. Kindly, those who are logging in, when you log in, mute yourself. And this will be now the basic etiquette of the class. Once you log in, just mute yourself to avoid interrupting the class. So my name remains Samuel Mbogwa because of those people who are joining us today. And our topic today is money and capital markets. So we are talking of the money markets and the capital markets. I want to take us through evolution of money. Or what is money? Where did the money come from? Right? And you know that money, since is a current medium of exchange, either in form of coins or banknotes. Now collectively, all we can say, money is basically assets, property, or resources that is owned by someone. So when we are talking of wealth, we are really talking of the property or the assets that you can call yours. And that is money. So you know money as a medium of exchange, a measure of value. Well, we have the characteristics of money. But as a medium of exchange, we know that it is used to buy or to exchange now the goods and the commodities. And I want to take you through the evolution of money since before, or can talk of some 3,000 years before Christ, when people are using precious metals. If you go to the Bible, or depending on the religion that you are in, there must have been a form of how people are exchanging. You can hear me? Am I audible from your end?
Yes. Yes.
Very well. You can make, in case of any fluctuations, you can just make use of the 3 buttons. You can chat. If I'm not audible, if you have a pressing question, a point of interjection, can do that. So I've categorized the types of money into 5. Now starting with the commodity money, or what we use to call barter trade. So I've said long before, even before the barter trade, we had in the Bible where the people are using the precious stones, precious metals, etc. And that is how gold now became the measure of value. And we started using gold at some point. But for the, Stephen, you are not on mute. Are you, Stephen?
Yes.
Are you on mute? Ata Maureen. Well, I've muted you from my end. It's okay. I've said I've broadly categorized the types of money into 5. And the first one was barter trade. So long before we know our grandfathers, our forefathers, they were exchanging goods and services. For instance, you could take a gallon of honey, get a sack of millet, or you take 2 goats, you get 5 bags of, you take 5 bags of maize, etc. That is what used to happen. But there was a big challenge. Now, how could you quantify how many goats are worth a bag of maize? Right now, at least right now, you have a measure of value. But back then, it was so challenging. For instance, right now, we know the prevailing market price of a goat is like, let's say 10 to 12,000, right? But back then, a goat used to be exchanged. Several goats could be exchanged with 1 sack of maize. You see, one party was being taken advantage of. So that was barter trade. or the commodity money, where the commodity now used to be exchanged with a commodity or a service. Then from there, we came into now the fiat money. Of course, fiat money is now the currency, the coins and the paper money. And this is now regulated by the government. It's a government order. So the government declares the money as legal tender and requires that all the people or all the firms, businesses, companies, etc., use it as a means of payment. So unlike commodity money, now fiat money is not backed by any physical commodity. It's only an authority by the government that this is our measure of value and it will be our medium of exchange. So by definition, you can say the money's intrinsic value is lower than its face value. It's just a paper, but because the government has considered it as a legal tender, that paper is being exchanged with a commodity or with a service. So that is fiat money. Now we have the fiduciary money, and fiduciary money now depends for its value on the confidence that it will be generally accepted as a medium of exchange. So this is not regulated by the government. So it has not been declared as a legal tender by the government. But it means that people who are exchanging it, now the fiduciary money, I believe that whatever you are giving me in return is equivalent to the value of the commodity or the value of the service that I'm rendering. And example of fiduciary money, we can talk of a check. Now, when I give you a check, until you regularize that check and it is honored, it is just a piece of paper. So we will meet somewhere in town. Let's say you have these goods, or there is a container that you have shipped from China, and you tell me this container is worth 3 million. I go ahead and draw you a check. Now, before that check has been cashed through my account, which is now fiat money, it is just a paper. True or false? So whatever we exchanged was a check, or what I call fiduciary money. Fiduciary, that word means trust. So you trust that whatever I'm giving you in exchange, or when we talk of the bank notes, when I give you a bank note, you believe that if I take this to the bank will honor the paper and give me money in return. So that is fiduciary money. Then we come now to the commercial bank money, and these are now the commercial instruments, or what you can claim in a financial institution, and you use it now to purchase goods or services. So when you go to the bank, they are going to give you a loan, or what we call the fractional reserve banking. So the process that the bank will involve in will be for ensuring that whatever the product that they are giving you in form of a loan will be exchanged for real money to buy goods and services. Are we there? I want to come to the fifth evolution of money, and this is where now the economy is. I would have said that fiat money has also by and by mutated. Initially, now you see the fiat money, we had a border issue. For example, Kenyan shillings will have you problems in purchasing goods or procuring services in Uganda. So when you are going to Uganda, you got to exchange the Kenyan shilling with Ugandan shillings for it to be acceptable to exchange the goods and services. And they realized that due to inflation, it affects the value of now the currency that you have. For example, if you go with Kenyan money to Uganda, I don't know, 1,000 Kenyan money, you are going to get, I don't know the changing value, but our money is of expense. I can use a dollar as an example. For example, $1 US, which is the global standardized currency for trading, is equivalent to 103 Kenyan shillings. If I go with 103 Kenyan shillings in US soil and I want to buy, it will be very hard. So at the entry point, I need to convert my money to US dollars for me to be able to trade in that country. And I've said that it is affected by inflation. So you can imagine the bulkiness. So I'll be forced to enter into the flight with like 40 kgs of notes. So that when I get to US, I'll convert my Kenyan notes into a few US dollars and be able to transact in US soil. So due to this bulkiness, also security, you see when money is on transit, can be stolen, right? So we have had the mutation of money now converting to what we call the electronic money, where a financial institution in Kenya will open an account. So when I go to US, for example, let's say I have a bank in Barclays Bank of Kenya, and I have a Visa card, my money will be in form of plastic money. So I can access the services in US soil, and then they will do the financial transaction via my bank. So through the either SWIFT code, we have the EFTs, electronic money transfer, we have mobile money, we have RTGS, all those platforms. So the plastic money will be physically be used in US to transact on my behalf. But where the money is in an account in Kenya. Are you getting? And all these developments is to ensure that we are trying to sort out now the problem of bulkiness, security when you are holding this cash on transit, etc. Now, the last one is even the more pleasing one, the fifth evolution of money. Right now, as we are talking, although it has not been accepted in our country, we know the cryptocurrencies, isn't it? This is the fifth evolution of money. So when we are talking of the digital assets, we are talking of now the fifth evolution of money. And the advantage of digital assets is, by digital, I mean you cannot touch it. So in some areas we are accepting, in some areas we are not. The government tells you cannot trade in Bitcoins, but we are trading in Bonga points. Safaricom are accepting Bonga points that you have accumulated in exchange of some data. Isn't it? If you go, there is a hotel in Nyeri called Betty's Place. Right now it is accepting Bitcoins. Did you know that if you travel using Virgin Atlantic Airlines right now, and you pay your air ticket using Bitcoins, it will be cheaper than using cash money. And we know Richard Branson is one of the richest persons in this world. He's accepting the digital assets. If you go to retail outlets, they have those merchant cards that you are normally given. If you go to either Naivas, Huskies, they'll give you a merchant card where after every shopping, they are going to accumulate some merchant points. At some point, you can redeem these points and get the goods, isn't it? This is a form of digital currency. So when I talk of fifth evolution of money, we are really talking of the virtual or the digital assets that cannot be touched. And we are already using it. Yeah? And this was a concept that was, the whole concept came into being in sometime in October 2008 by someone called Satoshi Nakamoto. Now, Satoshi Nakamoto is a pseudo name. Actually, we don't have such a person. And there is a reason why we have this. So you can imagine if we have a real person owning Bitcoin. If we kill this person and they are the people who are holding the private key to the Bitcoin, everyone who has invested in the cryptocurrency will lose their stake. Are you getting? So Satoshi Nakamoto is just a cyberpunk. This is just some pseudonym. No one knows who is Satoshi Nakamoto. Even all the other cryptocurrencies, we don't know the owners. And there is a reason. The reason is if we know the owner and kill that person, you're going to lose everything. So right now, as we are talking, our government has not regulated the Bitcoins. And Bitcoins, apparently, even Facebook right now, they are accepting transactions through Bitcoins. And you need to go and try to understand the cryptocurrency and see how interesting it is. We say it is the currency for the people, by the people. Gold was God's currency. And you see, it was incorporated in our reserves. For you to process any money, you need to have some equivalent of gold deposit in the central bank for you to process there. Of course, it's a mechanism of controlling the processing of money. Then we had the government currency, or what I'm calling fiduciary. And then right now we have the digital assets. So that is the evolution of money. I thought it was good to bring you abreast on how far we've come with this money business. So we enter into our day's topic is on money markets and capital markets. And I've explained what money is. So when I'm talking of now the money market, money becomes a commodity. And the money market now becomes the components of the financial markets. Because what will happen is there will be borrowing, lending, buying, selling, we'll be exchanging this currency, and that's why we are calling it a market. So a market is a place where you bring your goods, I bring my services, and then we trade. So trading in money market is done over the counter and in wholesale. So when we are talking of the money market, we are talking of short-term borrowing. When we are talking of the capital markets, we are talking of the long-term borrowing. And we have several money market instruments that are used. We have the treasury bills. And treasury bills, these are just papers. When the government needs to borrow money from its people, they'll float what we call the treasury bills. And this will mature before 1 year. So when the government needs money, they'll come to the Mwananchi and tell them, like right now, you have what we are calling Makiba, where with a minimum of 3,000, you can trade in the treasury bills. I think it is the cheapest in the Kenyan history. So the government is trying to bring these products to the people to ensure that everyone has confidence in their government and they can lend money to the government. And the government, of course, will give you back the money. So when you buy some treasury bills, the government will give you what we call the debenture certificates to show that you have lent it its money. So at maturity, if it is 9 months, let's say, government will give you back your money and some interest, right? Then we have the commercial papers. What are commercial papers? What are commercial papers? I don't expect our finance students not to be understanding these things. So you can say commercial papers, these are securities that are issued by large corporations to obtain funds. So if a company needs to meet its short-term debt obligation, for example, let's say due to Corona, you are not behaving so well as a company and you are unable to pay your employees' salary. So you can approach one of these large corporations and tell them, we want to buy some commercial papers. Of course, it's like an agreement. You give me money, I'm going to pay you sometime in the future because I'm not doing so well financially. So the advantages of this is that commercial papers, it's quick than the process of getting the loan might take you several weeks before the loan is processed. Commercial paper, I just come fill the papers today. Within a lapse of 2-3 hours, the money is in the account. I pay my employees' salaries and off we go. I await for the agreement to mature, then I'll give you back your money. So those are commercial papers. Then we have acceptances. When we are talking of the bank acceptance, a banker's acceptance is an instrument representing promise to pay in future. So the payment is accepted for now, but the bank guarantees that it's going to give you the money or deposit the money in the account sometime in future. And these are normally used in the offshore transactions. For instance, let's say you want to import a Range Rover Sport from UK. Now you cannot risk giving your 8 million to acquire this Range Rover. So the easiest way is to pay through what we call the banker's acceptance. So let's say your transacting bank is Barclays Bank. Barclays Bank will go to UK. They will pay the automobile dealer. You identify, of course, you first identify the car that you want to buy, then you notify your bank. Your bank will approach the car dealer in UK and pay them through a banker's acceptance. So it is not money yet. They just guarantee the car dealer that when you ship this Range Rover to Kenya, it is Barclays Bank that will pay you. And the customer has already deposited the money in our account. So you are secured. Your money will not be lost. So the automobile dealer will ship the Range Rover to Kenya. Once you get your Range Rover from KPA and you clear with the KRA and it is authentic, si ya kuibiwa, you tell Barclays Bank, I've already received my Range Rover. So they'll go ahead and deposit the money to the automobile dealer in UK. Is it making sense? So a banker's acceptance, you see yourself, you couldn't do a banker's acceptance to the automobile dealer in UK. But your bank has done that for you to be able to get the commodity, then they will deposit the money at maturity. If, for instance, they had guaranteed the automobile dealer, once we receive the Range Rover in Kenya, give us only 2 weeks, and we are going to deposit the cash in your account. Then we have others like repos, the repurchase agreements. We call them repos. Now, a repo is a form of short-term borrowing for dealers, especially in the government securities. Now, a dealer sells the government securities to investors, and these are usually the overnight transactions. I buy like today, tomorrow I sell. Maybe I have some information that the repos will be transacting at a higher cost. So today I'll be willing to buy. I give you that money. Tomorrow, I go get back my money. Of course, I'll have exchanged it at a higher value. That is why you hear the likes of, we have the business moguls like Akina Chris Kirubi and Akina Jim Nambaru. Because our market is so asymmetrical, information is with a few people. They can easily tell what will sell at a higher price tomorrow. Don't ask me how they get that information. I've said they are business moguls. So wewe unang'ang'ana kesho kuamuka kwenda kazini. When the sun is rising there, someone like CK is making hundreds of millions. Jua tu ikiwaka and Nairobi Securities Exchange ifunguliwe, he goes back and disposes the repos that he purchased yesterday. Worth of millions. That is how these people make money. Of course, you need to have that big money for you to be able to transact in some of these things. Then we have the federal bank. These are not so common in Kenya. These are in US or in Western countries. I have talked about the acceptances. I'm trying to see what is relevant in our country. Like the banker's acceptance, these are negotiable instruments. So it's a negotiable piece of paper that functions like a post-dated check when we talk of the banker's acceptance. So although the bank, rather than an account holder, guarantees the payment, banker's acceptance are used by companies as a relatively safe form of payment for large transactions. Are you getting? We said that the key thing to money is to ensure that you cut on the bulkiness and security. So what will happen is The big corporation will just do a paper. It's a negotiable instrument. So the bank believes that once this corporation makes all promises that they are going to honor the payment, it will be honored. That's why we are calling it a bank's acceptance. When you take it to the other bank, they'll just clear and give you the cash. So it is as simple as that. Then you have the participants in the money markets. So I can wind up by saying that money markets, they provide liquidity for the global financial systems. And this includes, or is not limited to, the capital markets. We have the broader system of the financial markets. We'll be coming to them by and by as we cover our areas of interest. Then we have the participants in the money markets. And the participants in the money markets, we have the financial institutions and the dealers in money, or the credits. So when I talk of the credit, I'm talking of the MFIs, those who either accept customer deposits and they borrow or lend. So participants will borrow and lend for short period, typically less than 1 year. That's why we are calling them money markets. It is so liquid. Within 1 year, you trade in your money and get it back. So money market trades in short-term financial instruments, and we commonly call them papers. So this will be in contrast with the capital markets because they trade for more than 1 year. And in that world, we call them bonds and equity. So the core of money market consists of interbank lending. Banks will normally borrow using the items that are indicated there above. And our basis, or we normally benchmark ourselves with the London Interbank offered rate. I said the other day that New York Exchange is the most stable market in the world, securities market in the world. So we normally benchmark US being the US dollar being the most stable currency. We normally benchmark most of these financial assets. We normally benchmark with US. So financial companies typically fund themselves through issuing what we call the asset-backed commercial papers. To mean, other than the paper that you are just giving me, there are those assets that you are going to tie to it. Could be shares, could be mutual funds, it will be on agreement. So I'm going to secure the commercial paper, but you are going to pledge some assets to back these transactions. And examples of the eligible assets, we have the auto loans, we have credit cards receivables, we have the residential and commercial mortgage loans, mortgage-backed securities, and similar financial assets. This is to mean I already have a buffer just in case you default on the commercial papers that we've agreed upon. So some large corporations with strong credit rating, they will just issue you a commercial paper in lieu of credit. Some will arrange on the commercial paper on your behalf. And I've given the examples of when you need to do a big transaction, let's say overseas. The bank can guarantee you because they have a relationship with that particular country, but you yourself, you don't have. For example, if you needed to buy a container of goods from China, how will China believe that if they ship the container, you are going to honor the agreement? They'd rather do it through the bank. Are we there? Or through a large corporation, yeah? Like the logistics companies like DHL. They will trust them than trusting you. So we normally do this. We have the trading companies that often purchase the bank acceptances and they'll tender them to the overseas suppliers. They are in that business. Some retail and institutional money market funds will do that. Banks, we have the central banks, cash management programs. We have what I was calling the agents. Yeah, we have the private agents. And I was saying the challenge has been due to mapping. They're being used And right now the government is taking some necessary measures before they regulate you to be a merchant bank or be an agent who is accepting cash on behalf of others. They are taking some time. Now, merchant banks, they normally handle big transactions. For example, let's say a retail outlet like Taskis. Right now, they have some financial problems, but they were performing so well. So let me use Carrefour. Let's say a big retail outlet like Carrefour, one day they might use even 800 million to pay their overseas suppliers because most of their supplies come from overseas. Now, this is not little money, and this is not money that you can get in any bank, right? Not any commercial bank will be willing to give you such money per day. You might exhaust their coffers on their safes. So merchant banks deal in such big transactions because even the access to the central bank reserve, their limit is also higher. And normally the tier 1 banks are the ones who are involved in these merchant transactions because they involve a lot of cash in it, right? So the functions of the money markets are: one, they maintain monetary balance between demand and supply of short-term monetary transactions. Of course, the government has come into play because of the monetary policy. Secondly, money market plays a very important role in making sure that the funds are available as and when it is required. So they ensure that the macroeconomic elements of money in the economy are well utilized. Thirdly, by providing funds to developing sectors, it helps in the growth of the economy also. So automatic. Then another important feature of the money market is that it provides discounting bills of exchange, and this will now facilitate the growth in trade. And this is what now what we call the monetary policy will be doing. We know that monetary policy is the mechanism that the government takes to control money to achieve the sustainable economic growth. So this now regulates or consists of the management of the money supply and of course the interest rates, and the aim of the government will be achieving the macroeconomic objectives. Ensure that they are controlling inflation, they are also controlling consumption, they are controlling growth, and they are also controlling liquidity. So when we are talking of the monetary policy, the implementation by the government is so key because they ensure that those aspects are met. We don't want a lot of money in supply. It will cause inflation. We don't want little money in supply. It will cause deflation. We want to ensure that the demand versus supply curve is met. And at the same time, we want to ensure that there is growth in the economy. Also regulating the liquidity in how much or what is in supply is also the aspect of the monetary policy of the government. So when we are talking of the monetary policy, the monetary authority typically gives the mandate to ensure that the gross domestic product is maintained, we have low rates of unemployment, and we maintain our foreign exchange and the inflation rates in a predictable range. You can imagine if one day we wake up and you woke up and you find, or the governor of central bank has given an order, let's say to process 1 trillion shillings. What do you think will happen? We are going to have inflation. So a commodity that was going for 100 shillings might end up being transacted at 1,000 shillings. So those people or the presidents that didn't understand initially how this works, they end up collapsing their economies. And this is where we got now countries like Botswana suffering, because they thought by processing a lot of money, they'll be able to cater for the unemployment rates. So instead of people suffering and they are unemployed, why doesn't the government, and it still has the mandate, go ahead and process this money? It's just a legal tender. They are papers. Then dish out to every mwananchi to make them financially stable. They didn't understand that it is being regulated from a global perspective. So monetary policy is used in combination with, of course, the other government mechanisms, or what we call the fiscal policy, like taxes, government borrowing and spending, to ensure that they manage the economy. And then lastly, the money market provides opportunity for short-term investment. And these, of course, provide for short-term savings, which in turn helps in the formation of the capital base for these corporations. So through the saving culture, they are able even to increase their credit worthiness and what they can access now from the coffers. Why do we need money market if that is the case? What is the need of money market? And I said that money markets, it's an open-ended mutual fund where the investors, even the government, invest in the short-term securities, commercial papers, negotiable instruments, and they call for deposits in return. Now, money market provides quick liquidity. That is one of the advantages. So the need remains that the industrial houses are able to meet their working capital requirements for short periods. Working capital is current assets minus current liabilities. So if the company or the business house is able to meet their obligations for the period, it increases the cost of funds because they are able to meet their day-to-day objectives as a business. So it is therefore always ensured that there remains a reasonable balance between acquiring liquidity and earning profitability. That's why I talked of the fiscal policy. You know, the government, and that is the powers now that the president has. For example, if a country is facing a high unemployment ratio due to recession, let's say, the monetary authority can opt for what we call expansionary policy to increase the economic growth and expand the economic activities. That way we are going to create employment. You saw what happened post-corona. After the government realized that most companies are closing, they had to come with kazi mtaani for the vijana. Yeah, that was an expansionary policy. So as a part of the expansionary monetary policy, the monetary authority will lower the interest rate, of course, through various measures to make money savings relatively unfavorable. And that is what happened post-corona. Banks, the first declaration that President made, he said that banks are supposed to give their consumers or their customers what we call a loan holiday. A loan holiday to mean you had given me money that I'm supposed to be repaying with some interest. You stop it. Because the economy is not functioning and I cannot produce, you stop asking me for that money until the situation is a bit favorable. So what will this cause? It will lead to an increased money supply in the market. Of course, this will boost now the investment and consumer spending. So the lower interest rate means that the businesses and the individuals can make loans on convenient terms to expand productive activities. So government went ahead, asked for loan holiday. They then went ahead and reduced the lending, the base lending rates. And this too was expansionary measure. Of course, the opposite now is what we call the contractionary monetary policy. So the government will ultimately, to curb the inflation, they'll come up with a mechanism of ensuring that the cost of living is so high, such that you are going to fear to spend. So I think you understand that very well. So you go ahead. So if the quick liquidity for a short-term period raised from money market fulfill its objective, it will serve the purpose for which the money market was created for. And of course, this one will be a bridge to overcome the deficit and the surplus cash flow. And since the transactions in the money market are for high value, occasionally they'll be for short period. We are talking of 2 weeks, we are talking of 1 month, 3 months, 6 months, at most 9 months. Most of these money market instruments, they lapse after the 9 months. So you come get the money, earn your interest, and off you go. So the transactions in the money market are done through different type of instruments like I indicated. Benefits. Why the money markets? It provides an easy mechanism to transfer a short-term funds. You said it's easier. Rather than following the long process of getting the loan, this one is almost prompt. And that's why we are saying they are called borrowers and holders of funds or cash assets. This cash is always on transit. It's only that I'm holding it temporarily. I return it, you give it to another person. So for the lenders, it provides a good opportunity of lending their surplus funds, of course, at an agreed rate. And then the money market will be subject to volatile rate of interest depending on the supply and the demand. And this is what the government now, through its fiscal and monetary policy, are able to provide. So we are saying that the focal point for control is at the Central Bank of Kenya to ensure that the liquidity or the rate of interest for the sustained economy is ensuring that we have an economic growth. We are not just moving this cash. It's not just cash on transit. The object is to ensure that there is economic growth. Any question? We'll be coming to money markets in deep. We have a whole topic called mutual funds, and that's where we are going to discuss in details some of these instruments. Then we go to the capital markets. Any question before we go to the capital markets? I have to keep checking whether we are together. Dolphin Makoha, are you there?
Yes.
Any question?
No, I don't have any question.
Do you feel like we have enough money in supply right now? There is a feeling that people don't have enough money. Do we have enough money in supply right now?
No, I don't think so.
You see, for a mwananchi, as long as you don't have that bulky cash in your account, there is a belief that there is no enough money in supply. But the government is otherwise. There is a lot of money in supply. Actually, the government is trying now to contract the economy. You know, it opened so many avenues for people to make money post-corona. Kama hujatengeneza pesa kwa hii corona, it's highly unlikely that you'll make money after the corona. Esther, do you have that money? Naipanoi, umetengeneza pesa? Then we have Nyamai Albanas. These are the people who had not joined when we were starting. Just checking on you and taking a slight break. Apparently, This has become one-edged. It's only the lecturer who is talking and the participants are not talking. Maureen. Maureen, are you there?
Yes, sir.
How are you doing?
I'm okay. What are you doing?
You have this money that we are talking about, or you have invested in cryptocurrencies.
I don't have any money.
You don't have money?
Yeah.
Well, don't go talking about not having money. You know you can be declared bankrupt and insolvent.
I'm bankrupt. I declare myself
Do
bankrupt.
you know when you are bankrupt? Do you know it's illegal to be bankrupt? Do you know what that means? You are
What does
risk
it
to the economy. What are you going to eat at lunch? Unless you steal, isn't it? Don't tell people you are bankrupt. You become high risk. No one wants to be associated with an insolvent person. You are a high risk.
It's the economy.
Yes?
But I don't have money. I'm just
No, we
saying
don't
that.
have, just say we don't have enough cash in supply. But the government is seeing otherwise. I'm telling you, there are people who have cashed in this corona. So we have a lot of money. Have you not heard of the KEMSA scandal? Where do you think that money is? So the government should ensure that that money is controlled. Yeah? The money went with the suppliers of the mask and the PPEs, isn't it? Where is that money? And you are saying that the government is in charge of the fiscal and the monetary policy. It's a very hard balance. So I want us to go to the capital market. And basically, when we are talking of the capital market, we are talking of the long-term lending. We've said that money market is 1 year. So when we are talking of a market where we get now the long terms, longer than 1 year, we are talking of now there, it ceases to be a money market and becomes a capital market. So there are two main functions of the capital market, only two, and I don't want you to take anything away other than this in this class. They bring together companies seeking capital and investors holding money via debt and equity instruments. That is one. The other function, they provide a secondary market where owners of those securities can exchange them. Just that, and that's why we are calling it a market. So it's a capital market. We are talking of huge investments. That's why we are talking of the debt and equity instruments. It's large amounts of money. So they bring together companies that are seeking capital. Let's say you want to expand and you don't have this money. The easiest way of getting this money is through declaring what you call an IPO, an initial public offer. So the money is with the public. And Maureen is saying that that money is not there. So they'll just give you that platform. What the capital market authority will do is to give you that platform. They give the companies seeking capital and the investors holding money to exchange that money. It is a marketplace. And then from there, they provide a secondary market. Once we have exchanged, of course, I'll not just keep my money in the account. It is a business house. So this money should keep on giving me something small. So they'll provide a secondary market again to the people who have invested, where they're now the owners of the securities will exchange them among one another. So it becomes a capital market place. With those few remarks, I can even close this class. I've completed. That is, by and large, that's all that you are supposed to understand about the capital market. Nothing more, nothing less. All the other things that we'll be discussing here are the functionalities, definitions, instruments that are there, etc. But I've explained what is. Now, so when we are talking of the capital market, the long-term fundings of these financial instruments, and we have a category of them. We have the debentures, we have the term loans, A term loan is a loan that is more than 1 year. Could be 5 years, 10 years. Most of them are long-term funding. Bonds, warrants, preference shares, ordinary shares, etc. These are the instruments of the capital market. I'm just supposed to ask you, in corporate finance, define a debenture. Or a question will be asked in your exam, and I'll go giving leak to the exam in this class. Differentiate between a debenture and a bond. So I want you to tell me a debenture is a medium or a long-term debt instrument that is used by a large company to borrow money. Of course, at a fixed rate of interest. What about a bond? Now, a bond will be a fixed income instrument that represents a loan made by an investor to a borrower. So you got the difference. Who can differentiate the debenture from the bond for us? Mutuko, Gumbao. Mutuko, I'd assume you are not in if you don't respond. Steven Jenga. Steven Jenga, are you there? Well, yes. Who can do? Yes, what's the difference between a debenture and a bond? Assume Mr. Mbogwa is a large company. Have you assumed that? And I'm coming to you to borrow money. What I'll give in exchange of the money that you give me is what I'm calling a debenture. So it's normally a certificate. It's like an agreement, ascertaining that I've given you 1 million and you are going to pay me an interest rate of 15% per annum for 5 years. So the exchange, that what we are going to exchange is what I'm calling the debenture certificate. Now the product is the debenture. So I've said it's either a medium or a long-term debt instrument. And normally it will be used by the large companies to borrow money from the other companies or from the other investors. And then a bond is a fixed income instrument representing a loan made by an investor to a borrower. So when the company is coming to me, it gives me a debenture. When I'm going to the company, I'll get a bond. That's the difference. But the rationale is the same. It's a long-term debt. So I thought that was wise. Then we have the functions of the capital market. One of them is providing long-term funds, which are necessary for investment. You said it's a marketplace. Then secondly, it provides advice to investors on which investments are viable. Let me ask you, is our market efficient? Is our capital market authority efficient? Is it efficient? Is the Kenyan Capital Market Authority efficient? This is the independent government financial agency or the regulatory agency. And it's in charge of supervising and also licensing and ensuring that the market instruments do not take advantage of either the investors or the borrowers, including the stock exchange. Again, I'll ask you that question on whether our market is efficient. So no one will ask you at this point, what are the objectives of the Capital Market So I'll just ask, is the Kenyan capital market efficient? And then I'll, of course, expect you to now discuss. In your discussions, you will say whether it is weak, whether it is strong or semi-strong. And we normally talk of the information that is trickling down. So when we are talking of the efficient market, the hypothesis or the theory states that the prices of the products of that capital market are supposed to be, the information on the prices is supposed to be symmetrical. And by symmetry here, I mean everyone, investors and the borrowers, they have full information. If you recall, in the macroeconomics, we talk of the consumer sovereignty. So we are expecting that the investor has full information, that if I invest, I'm going to get a return on investment. And the borrower has also information that if I borrow and then I get the net present value of this borrowing sometime in future, I'll have gained as a borrower. Are we there? Of course, the proponent of the now the efficient market hypothesis, they say that the investor benefits from investing in a low cost, or what we call a passive portfolio. And then the opponents, they believe that it's possible to beat the market because the assumption is that the value of these products or the stocks or the securities deviate from their market values. They fluctuate. So you cannot really be sure that KCB shares tomorrow will be selling at a higher value than what they were selling today, unless you have insider information, which is not relevant in an efficient market hypothesis. So you can see where I'm coming from. You said some business moguls will have more information than others. And it's a very serious balance to ensure that we have an efficient market hypothesis. So there is not that theory or hypothesis that stocks will trade at the fair market value. Some people have information, others don't have. And that's why we say when you see some people leave a company today, even if you had not planned to leave, go and dispose of your shares and buy some other shares. And I can give you a genesis of where some people have left companies and they end up collapsing. When Jim Nambaru left the Britam of Mauritius, which is the owner of Equity Bank, we saw what happened to the shares of Britam in Kenya and the shares of Equity Bank. So as a finance student, you are supposed to be having this information because this is what now hypothesizes an efficient market. And that is one of the key functions of the capital market in a country. So long-term investments are made liquid because there will be the transfer between now the shareholder who is being facilitated to get that borrowing. It also facilitates the international capital inflow. Of course, we are now able to do the cross-border investments. And our capital market authority has really grown. It has attracted a lot of investors, both locally and internationally. Those who are coming and investing in equity and debt instruments. And this is one of the key things that has made Kenya to be an economic hub in East Africa. Yeah. Then we have, it acts as a channel through which the foreign investment find their way into the market. I've already said that. So by definition, a capital market is a financial market. I said earlier that it has two things. It's a market. So in which long-term debts, by long-term we mean over 1 year, all equity-backed securities are bought and sold. And then it is divided into two. We have the primary market, where now the new stock will be issued also to the investors. A good example is a company that needs to raise, let's say, its capital to expand, let's say its branches in Kenya. So they'll go ahead and ask, or through application, they'll seek for a license to declare an IPO. That will be a primary market. So they'll be bringing new stock that have never traded before. And at IPO, people think that if you buy shares at IPO, you'll always get a profit for your shares. I want to bring now the rationale of what is capital market. You said it is long-term lending or long-term borrowing. When Equity Bank floated their shares in 2008, because they were the most profitable company in East Africa, everyone, shows, gukas, informal sector, juakali sector, they went for the Safaricom shares. Apparently, they didn't know that consideration is first given to big corporations. How many people here went for the Safaricom shares? Or I should have asked, where were you in 2008? Jacinta, Muya, where were you in 2008? Jacinta. You people are making this class to be so boring. This class is supposed to be so vibrant. Grace Nyevu. Grace, have you heard of IPO? Or has any company declared the IPO when you have you already had information on how IPOs operate? Grace. Again, quiet. Sharon. So no one is willing to share in this class. Sharon? Who is talking? Who can tell us what is an IPO or how they normally operate? An initial public offer. Telangat. Oh, Maureen is on. Yes, Maureen?
It's a process by which a private company goes public.
Goes to you're breaking, Maureen.
Goes public.
Oh, what do you mean by going public?
It sells its shares to the public.
So they declare an initial public offer, right?
Yes.
So they'll come and say, thank you, Maureen, for contributing. So they'll come to the public and say, we want to dispose of our shares. So to the public, they'll be investing in the company. But the company perspective is they are borrowing from the public. So it's a primary market. We've never done any business with you. I'm coming for the first time. That's why I'm calling it initial public offer. So I come for the first time and I borrow. So once you buy my shares, or once you go ahead and express interest in my shares, I'm going to allot you. So after the allotment, we have an agreement. If one share is let's say going for 5 shillings and you have 5,000, you are going to buy 500 shares. You become a shareholder in my company. But this shareholding is in form of an investment. On the other hand, you'll be waiting until the shares trade favorably, where you can make more money than you invested. That is the agreement. So when Safaricom came to the public in 2008, everyone rushed for their shares, not knowing they were borrowing to expand their business. So it took like 4 years before the shares traded positively. At some point, they had gone to a record low of 2 shillings and 65 cents. But when they first traded positively, they again traded abnormally. They traded at 12 shillings and 65 cents. So whoever had bought the Safaricom share, which was going at the IPO at 5 shillings, they made over 150% profit. So that is the nature of the capital market. So primarily, you come and borrow, make use of the funds to expand your business. Then after you've reached where you wanted, you now increase or value your shares. And you give now the investor a chance to dispose of and make a profit from their shares, or what we call in the business terms premium. So when I sell at a premium, what is over and above will be my profit as an investor. So the main entities, now I want to wind up this. The main entities seeking to raise long-term funds from the primary markets will be government, and we are going to have the business enterprises. So the government will come and float a bond. We said what is less than 1 year in the money market is called a treasury bill. So once it is over and above 1 year, the maturity period, we call it a bond. So the government, let's say, needs to run an infrastructural project like LAPSET. They want to connect Mombasa or the Lamu to Ethiopia. So the whole of that corridor will require a lot of funding. They'll come to the government and say, we have bonds that we are selling. So the interested companies will go and invest. The interested investors will go ahead and invest, awaiting for the bonds to mature. Of course, they'll be paid a fixed interest rate. That is a primary market. In the secondary market, we said now the existing. Once you've bought the shares at IPO, these shares, Safaricom will now take these shares to Nairobi Securities Exchange to be trading daily. So whenever the value will please you and you need money, you'll go and dispose of your shares, make your premium and go. Some people will go and make a loss and go because they need the liquid money. So you can see the difference now between the money market and the capital market. We said money market is so liquid. You can put your mutual or the what you call unit trust today and you sell them tomorrow and you make your money and go. But for the capital market, you need to be really an investor who is willing to risk, await for the prices to be favorable, then go ahead and dispose at a premium. So once they've been floated from the primary market, they are brought now to the secondary market. This is where now the investors or the traders will be meeting over the counter to make now the exchanges. So the existence of the secondary market increases now the willingness of the investors in primary markets, because they know even when I purchase primarily, I have where my product will be exposed and I'll be trading, or I have a chance to trade it in future. That is the secondary market. Then that is the end of our money and capital market. Any question? Any question? I said in Kenya, our CMA, the Capital Market Authority, is in charge of now the regulations. They supervise, they license, and they monitor the activities to make sure that the market is operating in a favorable environment. Yes, Pascaline.
What is the current status of Safaricom IPO?
What do you mean by Safaricom IPO?
Its current status.
Safaricom shares or IPO? You see, IPO was in 2008, isn't it? Right now, because of Corona, most investors are withholding. You know, also there are so many macroeconomic determinants that affect the pricing of shares, isn't it? Because of Corona, most companies are withholding. So we had a nosedive of most securities from March. But by and by, the market is now gaining the saturation. So it is not the right time to trade in shares right now. But Safaricom shares, they were trading between 25. I can get that information for you right now. You see that information. That's why you are talking of the market. That's why you are talking of the market symmetry. That information is in the public domain. It is normally gazetted every day, Pascaline. If you Google, you will get the price of the Safaricom shares today.
Okay.
Yes. The IPO was 5 bob in 2008. So because even the value of the shilling to the dollar has also increased, isn't it? So what 5 shillings could buy in 2008 cannot buy today. Could be what you will buy with 20 shillings today can be equated to what it could have bought in 2008. Are you getting the rationale?
Yeah.
So the work of the Capital Market Authority is to ensure that no one is taken the advantage of, either the investor or the borrower. Are we there?
Yes.
So they'll ensure that always, for an efficient market to prevail, the average cost of the shares will both favor the investor and the borrower who had borrowed the money. But if you Google, you can get the price of Safaricom shares, or you get today's newspaper. They are gazetted
Right.
daily.
Okay, thank you.
Another question? I realize if I Google, I'm going to collapse the class. But you can Google. The information is in the public domain.
It's 29.99 shillings.
It is 29.99. Pascaline?
Yeah.
Pascaline, do you have some Safaricom shares?
Not really.
You've heard they are trading at 29.99. Call it 30 shillings. So whoever had invested it, let's say at 20 shillings, if they dispose today, they are going to make 10 shillings per share. You get?
Yeah.
Yeah, but we are guided by the canon of higher risk, higher returns. If you have only 2 shares, you'll make 20 shillings, isn't it? If Jim Nambaru has invested 10 millions, you can imagine if he sells today and make 5 shillings for every share, it's a lot of money. That is how the market operates. The higher the risk, the higher the returns, and vice versa. Another question?
Excuse me, sir.
Mm-hmm.
Could you be sending us the recording after every session?
I'm supposed to send you the recording. The recording, I say the recording will be found in the YouTube of the ZDS content. Reason being, Dauphin, it is so huge. You get?
Yeah.
It is so huge. That's why we are compressing them into YouTubes. Materials that can even save your bundles. Or it's Fidelis.
Yes.
Another question? You the Mitani. Yeah.
Okay.
Steven Jenga.
Okay, my question is not for you particularly.
Mm-hmm.
But for the class, I'm just asking if there is a WhatsApp group for this unit.
I'm also
Yeah.
an interested party. Do you have a WhatsApp group?
Yes, 4.1, we've created a group so we can add the finance students.
Not lecturers.
Pardon?
It's for students only. I've said I'm an
The
interested party.
lecturer is also welcome.
Then you have the duty of adding us Fidelis. You have my number.
Yes.
You can add me back.
Okay, and the rest?
Steven is also requesting to be added. Isn't it, Steve?
Yes, I'm requesting.
Okay.
Okay, and I have a question.
Then you need to share your number with the Fidelis. How will she get your number?
I will send her my number.
So you have her number?
No, I will send her now privately. Yeah.
Okay.
And I have a question.
Ask.
Okay, if someone now wants to buy shares at National Security Exchange, which shares to buy would you advise someone to go in now as per the how the economy is going?
I've said right now it is not the right decision to analyze what to buy or not to buy because of the prevailing circumstances. I've said most companies are now withholding, but if I was to advise, right now the KCB shares are relatively stable. Steve.
Yes, okay.
Yeah, KCB shares are relatively stable. But you see the stability I'm talking about. You see, you don't know what they trade at tomorrow.
Okay.
You see the stability, you look at a period of time, right?
Yes.
Anything can happen today and they fluctuate there. Like most commercial banks, because as at the end of the month, they are giving now the bankers notes for paying the salaries and the like, they will trade at relatively lower to decrease the propensity of people accessing you get. So you have to understand the dynamics of the market. And that is why, Steve, you cannot go to Nairobi Securities Exchange to trade. Did you know that?
Yeah, I knew that.
You have to go through a broker.
Broker.
The assumption is a broker is a professional and they have information of how the market is doing. To get the broker has been put there because they have information that you lack. So when you go to your broker, they are supposed to advise you. If you go with this company's share today, you are going to gain. You get?
Okay.
Yeah, that's the work of the broker.
All right, thank you.
Any other question? Seems you are satisfied. Now, if you go to the portal, and I've realized there are some people who are not active in the portal, I've put a discussion forum there, and there is also an assignment that is due in our next class. So I want us, once I collapse this class, we all go to the portal and interact from the portal. Shall we? I want to stop sharing. And end the meeting. So enjoy your afternoon.